All right, everyone. The last problem for this chapter is problem 12-4B. We're going to take care of some selected stock transactions. And what you see up there on the wall is the following selected accounts appear in the ledger at the beginning of the current year. So I'm going to have him come in closer. So we have preferred stock, 2% stock, $80 par value, 100,000 shares authorized, 60,000 shares outstanding. So when we're looking at any kind of stock, so when we're looking at our stock terms, there's a term called authorized shares. And this is the amount that is in the Articles of Incorporation. So it's total shares available to be issued. So the Article of Incorporation will list the total shares that can be issued. That's the authorized shares. The company can't sell any more shares of stock unless they file an addendum and have it approved. So that's authorized shares. Issued shares are total shares that have been issued out of authorized shares. And then finally, we have outstanding shares. And those are total shares currently held by stockholders. So what you do is you have a big giant piece of pie that would be all of your authorized shares. Then the issued shares will be all the shares that have been sold to our investors, owners. And then outstanding shares are shares that are currently held by stockholders. So if we look up here again at this preferred 2% stock, $80 par, there are 100,000 shares authorized, and there's 60,000 shares issued and outstanding. They haven't listed it like that, but they have to be issued in order to be outstanding. So we have that. So that's the preferred stock. Additionally, when we're looking at par value, it is an arbitrary amount that is usually much less than the market value, but it's an arbitrary amount assigned to shares of stock. A lot of companies will have a 5-cent par value, and that par value is the amount that is par value times shares outstanding is the total amount that we're going to put into the stock account. So you've got your par value, an arbitrary amount assigned to shares of stock. And then you'll also see here that we've got right down here now, we have paid-in capital in excess of par preferred stock. And that's going to be the amount that we issued the stock for above the amount assigned, the par value. So into the stock account equals outstanding shares times the par value, and that's for both preferred or common stock. So, and then your additional paid-in capitals are the amounts that were received in excess of the par value. So, all right, so capital equals remaining amount. So you'll see here that we have two classes of stock. We have preferred stock and we have common stock. Our common stock has a $9 par value. 3 million shares are authorized and 1.75 million shares are issued. Remember, this amount here is going to be the number of shares issued times the $9 par value. Then we've got paid-in capital in excess of par common stock. Again, that's the amount paid over the par value. And then we've got our retained earnings account here, because remember that stockholders' equity is comprised of our stock accounts, all of these types of accounts here, as well as retained earnings. When we're dealing with preferred and common stock, when we're dealing with preferred stock is really a way to borrow money without going to the bank. So what you totally have here, you'll see it's got a much higher par value. It states that there's a preferred dividend of 2% times the par value. So when we get down to calculate out the preferred dividend later, we will calculate it as 2% of the par value. So, and preferred stock is generally preferred in dividends only. And you can have two kinds of preferred stock. You could have cumulative preferred stock, which means that every year that the preferred stockholders don't get paid a dividend, the next year before common stockholders can receive anything, the preferred stockholders need any of their amounts in arrears, or and then the current year until before common stock can get paid. So we've got that generally preferred with dividends only. They don't have the same rights as common stock. So common stock rights is the right to vote for the board of directors, right a right to even share of dividends, and then a right to a share of assets on liquidation. So it's important to remember that a company never has to declare or pay a dividend, because that would mean that a company might have to go out of business if they didn't have enough cash and they had to use up all their retained earnings in order to pay a dividend. So so when the dividends are there, it's an even share. I own 1 share, somebody else owns 10,000 shares. Each share of stock is going to get an equal dividend. There's a right to vote for the board of directors, who in turn are the ones running the company, and the right to a share of assets upon liquidation. So that's a lot of info in there, and we'll go back and forth as we work through this. And so in the problem, they've given us 2, 4, 6, 7 journal entries that they would like us to calculate during the year. So I'm going to go here for A. And A says they want us to, that the company purchased 87,500 shares of treasury stock for $8 per share. And companies and corporations buy back their own stock for things like stock dividends and stock bonus plans, things like that. And when we have treasury stock, it actually gets subtracted from total paid-in capital accounts when we're calculating out that amount. So here the company purchased 87,500 shares of treasury common stock for $8 per share. Since treasury stock actually reduces our paid-in capital amounts, we debit treasury stock when we make a purchase. So we record it as treasury stock. Remember, it's a debit instead of a credit like for our other stock accounts. And we calculate out the amount here as the total shares, 87,500 times the price per share. So we don't have an additional paid-in account that we're using right now. So we've got treasury stock, $8 times 8, that 87,500 shares. That amount is $700,000. So we're going to debit the treasury stock for that amount, and we're going to credit cash for that amount. So if I asked you right now to calculate outstanding common shares, we would have the 60,000 shares outstanding. We would have the 1.750 shares issued, and we would have to subtract the treasury stock if we needed to know the total shares that are outstanding, which means they're in the hands of stockholders. So that's our first journal entry. And then in the second journal entry, we're going to continue on here with our treasury stock. It says we sold 55,000 of the treasury shares common for $8 per share. So the first thing we're going to do is we're going to debit cash, and we're going to debit cash for the full amount that was received on this sale. So we're going to take our $55,000 shares, we're going to multiply it times the $11 per share. That's going to give us a total cash received of $605,000. So we're going to debit cash for that. We're going to reduce the treasury stock account by taking the 55,000 shares and multiplying it by the amount we paid per share of treasury stock. So we've got treasury stock. We're going to credit that account for 55,000 shares times $8. That comes to $440,000 for the credit there. And then the additional amount that we received from this sale is going to go into a paid-in capital from the sale of treasury stock account. I want to make sure I'm using the right term they want us to use here. So paid-in capital from sale of treasury stock. And calculating that, I'm going to put it up here as the 55,000 shares times the excess of $3 per share over the amount that we purchased it for a credit to the paid-in capital account of $165,000. So those are our first two transactions. For C, they tell us that they issued 20,000 shares of preferred 2% stock at $84 per share. So again, the first thing we're going to record is the amount of cash that was received in this transaction. And the problem tells us that we issued 20,000 preferred shares, and we sold them for $84 per share. So the amount of cash that was received is $1,680,000. So we're going to debit that, $1,680,000. We are going to credit the preferred stock account for the total shares that were issued times their par value. So here we've got preferred stock we're going to credit. I always spelled preferred wrong. So preferred stock, which is going to be the 20,000 shares times the par value, which is $80 per share. And so in that account, we're going to credit preferred stock for $1,600,000. And then the amount left over, the difference between the cash and the par times the shares issued, is going to be paid in capital in excess of par preferred stock. So paid in capital in excess of par value. And we're going to indicate that it's for common stock. Right? And that amount it's easy enough to do here. It's 80,000. That's just simple math. Or we can take the 20,000 shares and multiply that times the $4 we received per share in excess of the par value. So we've got those now. Then it tells us in D that the company issued 400,000 shares of common stock at $13 per share, receiving cash. So here, again, we're going to record our cash. We're going to credit cash by the total amount of shares that were issued of 400,000 shares. And we issued and issued them for $13 per share. That gives us a total amount for this transaction of $5,200,000 that was received. So we're going to debit that to the cash account. Just like we did with the preferred stock, we're going to increase the common stock account with a credit, and the common stock amount we're going to put in there is the number of shares issued times the par value of the common shares, which is $9 per par. And that comes to a total of $3,600,000. Here, I did make a mistake here. This should be for par value preferred stock. All right, so we've got our cash, our common stock, and then in addition, we'll have paid in capital in excess of par value. And I will put the correct designation here that it's for our common stock. And so you can either take the difference between those two if you want to calculate it out just to make sure you're doing everything right. You would do 400,000 shares, multiplying it times $4 per share, and that's going to give you a total of $1,600,000. Sorry about that. All right, so then our next item is E, and they tell us that in E, we sold treasury stock. We sold 18,000 shares of treasury stock common for $7.50 per share. So we're going to debit cash, and we're going to do it by the number of shares that we sold. So that was 18,000 shares of common stock, and we sold them for $7.50 per share. So that amount that we're going to put to credit to cash is going to be $135,000. And you'll notice here that unlike in this transaction here, we actually, where we sold the treasury stock for more than we paid for it, in this situation, we actually sold it for less than what we paid for it. So here, what we're going to do here is instead of crediting the paid in capital from sale of treasury stock, we're going to debit that account. So that's going to be a debit to paid in capital from sale of treasury stock. So again, this is going to be 18,000 shares times 50 cents a share. That's the amount that we sold it for less than. That's going to be $9,000. And then when we make the credit to the treasury stock account, it's going to be for the total shares that we sold times the amount that those shares were originally purchased for. And that comes to $144,000. At the next one of our journal, the next transaction is we declared cash dividends of $1.60 per share on preferred stock and 5 cents per share on common stock. So the first thing that we're going to calculate out here is we want to calculate out the cash dividends per share on the common stock. So if we're looking at our shares have $80 par. So if you look at preferred dividend per share, what we do is we take the par value of $80. We're going to take our par, $80, and we're going to multiply it by the percent that they've given us, which is 2%, and that's going to give us a dividend per share of preferred stock of $1.60. So we can calculate out the amount of the preferred dividend if we take the total shares outstanding. So we need to look at preferred shares outstanding. We started out the problem and we had 60,000 shares outstanding. So we had 60,000 shares. And then we issued another 20,000 shares. So that gives us a total of 80,000 shares outstanding. We're going to multiply that times $1.60 per share, and that's going to give us preferred cash dividends of $128,000. So, and I do know that I believe the problem did give us the $1.60 per share, but I wanted to show you how to calculate that out. And then they've also told us that the common dividend is 5 cents per share. So we need to calculate out common shares outstanding. So we start at the beginning of the period with a total of 1,750,000 shares. So those are our shares at the beginning of the year. In addition, we issued an additional 400,000 shares in transaction D. So we've got the 400,000 shares issued. And then we need to subtract the treasury shares that are outstanding. So remember, at the beginning of the period, we're looking at our treasury shares. We started out with 0 shares. Then in the first transaction, we purchased 87,500 shares. Then we had 87,500 shares purchased. And of those 87,500 shares, we sold 55,000. And then later we sold 18,000 in transaction E. So we're going to subtract those 18,000 shares sold. And that's going to give us total treasury shares that we have. Let me find where I put it in my notes. So we end up with total treasury sales of, I'm going to need you to pause that 1 second so I can calculate that out. Sorry about that, guys. I hadn't calculated out one of my subtotals here. So when we're doing total common shares outstanding, we start with 1,750,000 shares. We had issued 400,000 shares, and we need to subtract total treasury shares that are held. I'm just not put outstanding here so we don't get terms confused. To calculate out treasury sales, we didn't have it. We had 0 shares at the beginning. Then we purchased 87,500 shares and subsequently sold 55,000 and 18,000, which give us currently 14,500 shares of treasury stock. So I'm going to put that here, 14,500 shares of treasury stock, which is going to give us total shares outstanding in stockholders' hands of 2,135,500. So now I can calculate out the common dividends. So we've got our common stock dividend. Is going to equal 2,135,500 shares times 5 cents per share. And so the common stock dividend is going to be $106,775. $106,775. So when I make my journal entry to recognize my total dividends for the common and the common and the preferred shares, I'm going to enter that over here. I'm going to start out, and I'm going to record, because this is the date of declaration, and that's the day that the liability is incurred, and we have to record the cash dividends. So I'm going to debit cash dividends. So I'm going to debit cash dividends for the total of the preferred shares of 128,000 plus my common dividend of $106,775. I'm going to add those two together, and that's going to be $234,775. And then I'm going to credit the liability, cash dividends payable. For the same amount. And so remember, we've created, this is the data declaration. On the data declaration, the company says we're going to pay cash dividends of this amount that'll be payable to stockholders of record, which is a date which doesn't require an entry, on the following date, which is the date of distribution. So then in the last journal entry, they want us to record the actual payment of the cash dividends. So I'm going to debit cash dividends payable for the full amount of $234,775, and I'm going to credit cash for the payment of $234,775. And that's how we complete this problem.